Is it time to buy C3.AI stock? In full disclosure, I do own some AI stock. I'll talk about that in a second. First, I've done a few videos on C3.AI along the way calling out, yeah, there's 80% downside. It subsequently did go down 80%. So I did nail that initial call. So lesson learned, valuation matters. Now, why did I buy C3.AI or AI stock? So this sort of, it's important to understand everyone has their own different journey. For my diversified growth and value portfolio, I sort of have a skewed barbell approach where at one end, it's sort of concentrated bigger bets in companies where I think there's less downside. And, that's what I'm banking on, where I'm sort of saying, hey, I don't think there's a high risk of permanent impairment, or the business model's already proven itself and the valuation's compelling. So that's sort of bigger bets. On the other side might be more speculative companies, haven't yet fully proven their business model, or the valuation isn't super compelling. So maybe it's a 1% or under bet. So that's why, when I look at these two different buckets, one is sort of bigger bets, deeper value, maybe not growing at hyperspeed. Maybe it's a cash flow, a significant cash, flowing company with a dividend, but, instead of growing at 20, 30%, they're growing at 5 to 10%, but there's that nice cash flow yield. This is more that speculative bucket that for me personally has a smaller allocation, but look, everyone has to have their own investment journey. I'm just sort of sharing my own approach, how I consider this. When I look at C3.AI, there's a little bit of a pattern recognition, like ding, ding, ding going off. When I look at this, you have a proven serial entrepreneur who has seen past market cycles, and he launched another business with high recurring revenue and rich gross margins. And so he's seen this, with the dot-com bubble and implosion. He saw what happens. He saw, effectively how companies got wiped out, how there was this huge cash burn. He previously had Siebel Systems, which was acquired by Oracle, and shareholders from the IPO to the time of exit did fairly reasonably well with a teens return for Siebel Systems shareholders. At least that's how I pencil it out. And so I'm looking at this, and this, for me personally, this sort of pattern recognition has worked out favorably in the past when I looked at the Trade Desk CEO and I was like, oh, here's this guy, serial entrepreneur, previously launched a business that was ultimately sold to another business. It's worked out very well for him. And so that's when I bought, the Trade Desk a few years ago. Since then, the stock has gone to absolutely crazy valuation. It was, a 10x plus for me. But, it's important to recognize, valuation matters. Trade Desk is no longer a big part of my own investment journey. Everyone has to figure out, what's the right balance between quality and valuation, on their own, investment path. But to understand C3.AI now, historically, you look at enterprise application software, and this is a multi-$100 billion market where businesses have data, they need to organize it, and then they need to have various different applications that help them say, okay, well, what are their customers doing, or what's the supply chain look like? What's the underlying business look like? What's inventory? What are their employees doing? The way to understand that is past enterprise application software is about description, about saying where has the business been, whereas what you're looking at with C3.AI is that it's going from descriptive to predictive, saying, hey, yeah, this is the number of employees you might have in the future based on churn, or these are the parts in the inventory you might have trouble getting, or this is going to be the failure for these different parts, or these are the customers that you're more likely to get. So it's layering on a predictive element to software that's historically been descriptive. And so management thinks, Tom Siebel and others think, that this angle of taking artificial intelligence, trying to have some sort of predictive element, could be a $600 billion market in the next few years. Just an absolutely huge market. And they argue that they're one of the largest players here, and they're tapping into many different industries. It's not just concentrated in one, though they do have some concentration in oil and gas, which I'll talk about in a second, but it's really all over the place, from financial services to manufacturing. Hey, supply chain's really messed up. How do you track for, where a product is? If, let's say, there's problems with China, how will you outsource it to another country? What are your different options there? Aerospace and defense, if you're saying, hey, does our Joint Strike Fighter, fleet, is it ready? What's the problem? What are the parts that are more likely that are going to effectively force these planes to have downtime, these $100 million, planes? So you have all these different industries that are predictive. Software analytics can have huge component. Now, they do have this contract with Baker Hughes, one of the largest oil field services businesses, That represents around 30% of their revenue, but it's worthwhile to understand that Baker Hughes is also effectively a partner, like a reseller of their software. And they do break this out in their annual report saying, yes, Baker Hughes, they've been subscribing more to their business, but they've also been effectively as a reseller dramatically selling to new customers. You've seen over the last 3 years, it's gone from 6 million to 27 million in terms of Baker Hughes effectively reselling it to different customers that they know. So this is all in around 40% of their business. While I typically don't like seeing concentration like this, and this is once again why it goes into that other bucket of sort of smaller bets for me, because, if you have one 30-40% bet, that can cause a lot of heartburn if things don't quite work out. In this environment where oil prices are arguably, at potentially a new level where they could potentially go higher for years to come. You see Warren Buffett making sizable, oil bets. This isn't necessarily the worst place to be right now, where you have 30-40% exposure, where arguably everyone wants to know, hey, which well is going to go out of business, or which well is going to dry up faster? Where should I be drilling? Those types of questions of, hey, how do I make the most out of, how do I optimize my drilling yield? Those types of questions, those types of predictive, analytics questions is very relevant, and C3.AI, I'd argue, is in a sweet spot here. But it's not just oil and gas. You're looking at chemical companies signing major 5-year contracts. You're seeing health care, U.S. Department of Health signing major contracts. You also see the Department of Defense sign a mega contract, $500 million agreement at the end of last year for 5 years. That's potentially a big deal, especially given that last year they only had $250 million in sales. This is another reason why I own C3.AI in terms of that small basket of companies. Now, look, I'm not pounding the table saying, hey, you need to go buy it yourself. Everyone needs to figure it out for themselves. But I'm sort of saying, here are some of the data points I'm considering on my own investment journey as I consider C3.AI, which is when you see something like that, Department of Defense, announcing a $500 million contract, that is relatively small potatoes for the Department of Defense, many hundreds of billions of dollars, effectively their annual budget. And so you think, wait a second, it wouldn't be that crazy to imagine, let's say, $1 billion contract or a $2 billion contract in the future. And for a $250 million company guiding to around $300 million in revenue this year, that could potentially move the needle significantly. So that's part of the reason why it's a small stake. If they execute, maybe it can become 10 times bigger over, let's say, the next decade. But if they don't, it's a small stake. I'm not overly concerned about it. So that is, sort of how I'm thinking about this, which is, this could be like a lottery ticket aspect. If they win more sizable contracts in the future, maybe that really moves the needle for them. So the question is, where does C3.AI go from here? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. In full disclosure, this is not financial advice. This is financial analysis. And so looking at this, looking at C3.AI, thinking about their business, the valuation, where's the stock go from here? It's first important to understand they are not at scale yet. Their losses are nearly as big as their revenue. They had 56 million in operating losses last quarter versus 72 million in revenue. For the year, nearly 200 million in losses versus 252 million in revenue. So this business is investing significantly in sales and marketing, R&D, and they're not quite at scale yet. So their general and administrative costs are above 20%. But it's worthwhile to understand that, first of all, that loss figure isn't as bad as it initially looks, partly because you do have a sizable amount of stock-based compensation. So that I don't really care for, because that means you have a lot of dilution. We'll talk about that in a second. But it does mean that their cash burn, is around a little under 100 million for the year. Maybe it could be less depending on how you're looking at it. So at least 10-year runway based on their existing cash balance, which is, a little under $1 billion. Now, while all these things don't exactly get me excited, saying huge losses and, sort of business that's subscale. Once again, Tom Siebel, he's done this before. And in the last few months, he called out how if he wanted C3.AI to be profitable within 90 days, he could do it. But he's saying, look, long term, I want to build this business. So I am going to invest a lot, 60% plus in sales and marketing, 60% in R&D. Most companies aren't doing that. He's saying it's important for me to do that because this market opportunity, this $600 billion market opportunity is so big. And so he's saying, yeah, in the next 2 to 3 years, that's when we're going to get to, positive free cash flow, positive potential earnings. Long-term target margins are greater than 20%. I personally think that, that target is very achievable, at least, based on the sort of metrics he talks about, how you could bring down, when you get to scale, you could bring down sales and marketing to like 15%, 10 to 15%. You can get, G&A costs down to 10 to 15%. Keep in mind, this is a business with 80% gross margin. So when you get those costs down, you're looking at a business that at maturity, sort of thinking about their long-term optimized margins, could be 20 to 30%. At least that's how I'm personally thinking about it, looking at what could be. One of my concerns here, thinking about C3.AI, is a lot of their value is sort of building their software on top of, let's say, existing applications. So you have Salesforce, but then you want to build, effectively an application that predicts which are your best customers. And Larry Ellison, at Oracle, he's no dummy. So he sees what Tom Siebel's doing. He's done this in the past where he said, oh, I like what you're doing, Tom Siebel. I'll launch a competitive product and then I'll just buy your company outright. So it does make me concerned that will you get more pressure from existing, software vendors that say, yeah, we recognize our historical angle was this sort of descriptive component. We too are going to be offering a predictive sort of machine learning component that'll drive sales going forward, sort of an upselling solution. Could that disrupt C3.AI in the future? That is sort of an existential threat that I'm mindful with C3.AI. So I want to see how it develops in the years ahead. And that's part of the reason, once again, I have it as this one of more speculative bets. It's the smaller bet because the future isn't as certain for this. It's sort of a murkier picture. But once again, I like Tom, the fact that Tom Siebel, this isn't his first rodeo. He's seen the ups and downs. He thinks, look, if there's a bad market, he's prepared for it. He has his own personal balance sheet, and C3.AI has hundreds of millions, sub $1 billion in cash on their balance sheet. So they're prepared for it. So he's mindful of these different things. This is just a competitive aspect that I'm on the watch out for. You do look at insider sales. That's nothing to get really folks excited about. If anything, some might be concerned to see, hey, the CFO, the CTO, the chief product officer continue to sell stock. Really, once again, I'm focused on Tom Siebel, and it's interesting to see that he was selling stock along the way to the tune of $30 million as of November, but that was around $50 a share. And since then, he stopped. And I think that's a recognition that he's like, this is just getting too cheap. Now, that's up to investors to decide. I think it's important to recognize there's a lot of diluted shares that folks don't really consider in their valuation. And so they are actually much more expensive than a lot of folks are penciling out. It's closer to a $3 billion plus valuation at $20 a share. That dilution has come in even higher than what I initially expected, when I started buying it over the last few months. So that's put me sort of at pause to sort of say, hey, I want to, buy a lot at scale. It's still not yet at a dirt cheap valuation when you factor in all this dilution. And that's part of the concern. So it is trading around 6-7 times sales. Long term, I think it's possible to have, let's say, 25% margins. Management's guiding to around low 20% growth for the year. Maybe some of that's, being conservative. So I put a range of 20 to 30%, then range over, let's say, the next 5 years of 25 to 30%, because they are tapping into this big market opportunity. And once again, winning some major contracts from the government, $1 billion contracts, can easily move the needle, growing them from, let's say, a $300 million revenue business to, let's say, a $700 million to $1 billion revenue business. So thinking about these margins, an appropriate tax rate, an end multiple 5 years from now of, let's say, 20 to 25 times. And that effectively gets you to break even to slightly higher. When you factor in that they have the sizable cash balance, it does sort of skew it to, hey, maybe you sort of break even, maybe you're up 100%. This valuation doesn't really get me super excited. And that's part of the reason, once again, even though it's not deep value based on, the high diluted share count and the fact that the stock's down so much, I do like the market opportunity that they're addressing. Tom Siebel is a serious guy, in my opinion, does have the potential to compound at 20 to 30% for years and years and years. The challenge is like, hey, are they going to work through that valuation? Will they win some, let's say, mega deals that could reaccelerate their growth? And is that possible that you see that? Am I being potentially too conservative, too aggressive here? And so I'm looking at this and sort of saying it's not going to be a large bet for me because you have all these dynamics that I've already called out, potentially competitive dynamics, potentially, hey, will they actually execute and deliver, let's say 25% growth in the years ahead? It's possible I'm being too aggressive in this scenario. Maybe it should be lower. So this is a range of scenarios that I'm looking at, and we'll see sort of how it plays out. If this video has been helpful for you talking about C3.AI, please make a point of hitting that thumbs up, hit that subscribe button, and thank you for watching Unrivaled Investing.